Okay, so here is my recording of how we Whitkins are doing our stock investing. Our general goal is to earn enough passive income that we don't have to work and to eventually have enough money to buy a dream house. Um, Keep in mind that our stocks are only one part of our total net worth. Um, Most of our money currently is in residence, our house. As the stocks grow, this balance will change. So, our diversity is basically trying to make sure that our various investments are unrelated. So, our Sydney house doesn't go up and down when the US stock market goes up and down. So, one of the notable things about how we're investing is we think we're going to achieve 30% growth over the next 10 years at least. And that's because the stocks we're holding grew 42% on average over the last 30 years. We think they're going to keep doing that. I'll talk more later about which they are. The other investment blue columns here are more typical stock investments. So the rightmost one is, for example, a Vanguard ETF or exchange traded fund that you can buy easily. You can see that it returns around 12% average. NASDAQ, the top 100 stocks in NASDAQ, also around 12 to 15%. So, yeah, we're planning for a much higher growth. The way we basically are doing this is we buy some stocks, we wait until they reach a certain target value, and then we start selling a little bit of them, but not so much that we remove all the growth each year. And so while we're selling a little bit to live on, it continues to grow. And once it's grown enormous, we then sell more of it to buy our house. So these are the specific rules we use to decide when to buy or sell. So while our investment is under 500K, we're waiting. Then when it's grown between 500 and $1 million, we harvest some, 100K a year. And if and when it gets above a million, we harvest more, like 280,000 a year. So if we had started in 2011 and bought the stocks that are currently in our stock portfolio, here's how our plan would have worked out. I'll talk more later about what's in the portfolio, but right now, just imagine we bought a bunch of stocks in 2011 and we spent $100,000 on them. This little blue bar here represents the 100K. So we would have waited until it grew to 500K, and that would have taken 5 years. In year 6, we would have taken some money out. Here we're taking out 280K, which is actually not according to our rule, which said that we should only do that over $1 million, but we got excited, let's pretend. So we were left. So our stocks grew from 2015 to 2016. It's a massive growth year, and they went up almost to 900,000. So that's this level here. And then this red represents the money we took out. So at the end of 2016, we only had 600,000 because we took out almost 300. 2017, another strong year. Here we were in 2016 with 600. It grew to $1 million in 2017, and we took out another 280K. So that left us with 700,000 at the end of 2017. Now, 2018 was a terrible year. The 700K here, again, ignore the red, that's been taken out. At the end of 2017, we had 700K, and it shrunk down to 550K here. It's still above 500,000, so we still took out 100K. Let's say it ended at 400K. So in 2019, it grew from 400K here to 600K here. Took out another 100,000. And here it grew to over $1 million. So by our rule said we could have taken out 280, but we were a little nervous because of that big crash, so we only took out 100, let's say. So we had $1 million left after taking that money out here. 2021, Another amazing growth year. So it almost made it to 2 million. So we took out the full 280,000, leaving 1.6 million. Big crash year in 2022. So our 1.6 million dropped all the way down to 600K. That's below a million, so we only took out 100K, left us with 500. At 500 in 2023, it grew all the way back up to 1.6 million. So we took out our full 280K, leaving us with 1.3 million. So that's the end of this hypothetical example. Now I'll show you a different one where in this one, it's the same thing except that we waited longer before taking out our first amount of money. Instead of taking out that 280K early on, we waited until it grew more. If we had not taken any out, it would have grown to 3 million by 2020. And at this point, we just take out 280K every year without having to vary the amount. Because as you can see, it's worth way more, like 7 million by the end, or 6 million by the end of 2023. So what's in this portfolio? So here's our actual portfolio that we have right now in terms of percentages. You can see that NVIDIA is an enormous amount of it. It didn't used to be so big, but it grew massively recently. So we also have other common tech stocks like Tesla, Google, Netflix, Microsoft, Adobe, Apple, Autodesk, and then some of these other ones which make chips for tech stocks. In this 10 other slice, we have some non-tech stocks, but mostly, as you can see, it's tech stocks. Here's what actually happened to our portfolio when we actually started investing. That previous one was a hypothetical, if we'd started investing in 2011. Here's when we actually started using this strategy, just in 2021. So you can see it boomed upward, it grew 50%, it shrank down, and for a while we were actually below when we started investing, and now it's currently 75% higher than when we started. Compare that to what NASDAQ's done, you can see why our stocks we're predicting 30% average annual growth. So historic returns of these stocks that we're holding, you can see in general the pattern is that during good years it's really a lot higher than a Vanguard growth fund. During bad years, sometimes we have good years when they have bad years, but most of the time sometimes we have bad years when they have good years, or neutral, like here. But the general trend is our good years are much better, and our bad years are maybe roughly similar. So if you want to get into the detail of exactly what each stock did on each year, here's a chart that shows you. Possibly the most important numbers are here in this row where it says return. This is the return year on year of every year since 1992 of the stocks we hold. Now, some of these stocks didn't exist in the early 90s, and when they didn't, you'll see a Microsoft's number put in here. Here, for example, in 1996, Microsoft returned 94% earnings. And you can see 94% is all the way down here. That means those stocks didn't exist, so we were holding Microsoft then. Down the bottom here, you'll see the returns of various typical investments, such as a Vanguard fund, the NASDAQ, the entire NASDAQ composite. That means all of the stocks in NASDAQ. Here's the top 100 of NASDAQ. Here's Dow Jones. And here's some other typical fund that an investor might recommend, a financial professional might recommend you buy. So you can just see that there's kind of night and day differences. The other interesting thing is that on bad years, everybody loses. These stocks all lose a huge amount. Our stocks often lose a huge amount. So, but they aren't very coupled, and that's kind of interesting. But there are years in which certain stocks, like for example this Qualcomm stock, returned in a staggering 2,400% return, 24 times as much money as you put in. So that's a real number. It's hard to believe. I checked it several times because it was so insanely high. But that's kind of why these stocks do, why 30% is reasonable. Like here, for example, um, this company returned 3 times, and 3 times isn't even that unusual in this chart. Here's 2.5 times, and so on. Whereas these other investments never return anything above 100%. They're just much smaller growth by comparison. So like I was saying earlier, in order to model our historic performance with stocks that didn't exist, what I did is I substituted Microsoft. But there's kind of a problem with that, which is that Microsoft, that assumes we would magically identify early growth stocks the minute they appeared on the market. So to compensate for that, this stock continues to hold Microsoft even after a winner emerges until that winner has been traded for 5 years above 30%. And it is true that these stocks are ones that I personally believe in. These are companies that I feel like I know something about. And so it's not just, the simple list of every stock that returned above 30% for 5 years. Although I think you probably could do just as well, or close to just as well, by using that simple rule. So this is comparing our performance to real estate. So this is if you had put in $100,000 in 2010 and then sold whatever you put it in 2020, held it for 10 years. So if you had bought a mortgage home and put down 100,000 in 2010, gotten your mortgage, and then sold it and paid off your mortgage, you would have made 100, 200, 300, 400, 450,000 on your 100,000. An investment condo, which had rental income, would have done better, 5 or 600. An unmortgaged home means you just paid cash for your home and sold it for whatever it's grew to. So you would have gotten around 150,000 on your 100. Whitkin portfolio, you would have gotten 2.6 million. That's really a lot more than any of those. And your Vanguard and NASDAQ indexes would have gotten you, similar to a house. So this is surprising to a lot of people because we assume that there's big advantages to owning homes. Those advantages kind of pale in comparison to 30% average annual growth. So even if this property you have a mortgage, even if you get a tax deduction for that mortgage interest you paid, and even if you get rental income, and even if you bought in quote unquote hot markets like San Francisco or Sydney, it still is nowhere near what these stocks did. Okay, so how do we deal with risk? And I think this is probably the big difference between us and other stocks, which is that we deal with risk not by holding quote unquote stable stocks, but by holding high growth stocks who are highly volatile. I mean, they go way up and down every year, but we just wait longer before selling them. So what this chart's trying to show you is that these light green bars here are single year returns of our portfolio. You can see that they vary widely. So some years they're really high, some years they're negative, they lost money. There's a few 2-year periods. So this darker green is 2 years. That also varies quite a lot. Once you look at the 5-year period, this means you pick any random 5-year period since 1992 and you buy these stocks, you wait 5 years and you sell them. How badly could you have done? The answer is you still would have gotten at least 20% return, even if your timing was terrible. And 10-year is similar to 5-year. The worst you would have done is around 27%, I think. I have a chart that shows the exact numbers in a minute. The point is, if you buy and wait 5 years, you can reduce your risk. Of course, it's easy to say and really hard to do when the market crashes 50%. And that's a really big requirement of any investment, is you have to be able to sleep well at night. Here's how we do it. First, we understand what we're doing, which is that we're long-term growth stock investors. There's other kinds of investors, like Warren Buffett is a value investor. He's also long-term, and I have a bunch of slides that talk more in detail about that. But the key thing, the fundamental thing behind our investment is that we think that tech will drive continued growth of stock prices basically forever. This is a logarithmic scale. This is not a linear growth. So this is showing a doubling. Each of these lines is the stock market doubling in value. It's been doing this since 1987. The trend is really clear, and we think it'll keep doing it. Now in the short term, so you can see this is a 5-year period. Like you saw in my example, it goes way up and way down. So if you can focus just on the 5-year window, then you'll be fine. If you start looking year to year, it's really stressful. So if we lost sight of this 5-year trend, we would be freaking out because we would have a huge amount of money and we'd lose half of it, quote unquote, and we'd lose some more because the next year is bad, and at which point we might panic and sell. And that's when we're in trouble. If we just waited, we'd be fine. The other confusing thing about this kind of investing is that it's not a linear growth. And all humans, including me, are really bad at imagining exponential growth when they're played out on a movie style timeline. So it basically feels like nothing much is happening for the first half of your investment period. And then it suddenly starts happening really fast. So that's basically, if you can be patient for the first half of your investment period, whether it's 5 years or 10 years, then it'll be good. And one of the challenges with this kind of investing is that there's constantly market news and that you could buy or sell at any time easily. If you think of this more like a house, where you buy a house and then it's really a pain in the ass to sell, and so you don't really plan on selling it or even thinking about selling it for many years, then this works great. So this is really difficult because a lot of stock market investors do buy and sell in short-term events. So you have to really adapt a different mindset with your investment, which is that you're just going to buy and wait and ignore it for many years. All right, so if you want to do the strategy, here are the decisions that you need to make. There's basically just 3. How much should you invest? How long are you going to wait? And what is a safe amount to start harvesting or selling a little bit of it? So for the first decision, how much to invest, the less you invest, the longer you got to wait is basically the simple way to think of it. So in this example, let's say that instead of investing 100,000 in 2011, we invested 200,000 in 2015. We could have theoretically skipped this time, these 5 years. So we would have gotten the same outcome in 5 years instead of 9 by investing more. But that also does increase our risk because we don't know what exactly would have happened for those 5 years. The longer time you hold, the more that you average out to your annual growth. So how much does that matter? How much does, like, for example, 5 years versus 10 years matter? So if you took any period of time since 1992, let's say a 5-year period, the best 5-year period since 1992 was a 66% average annual growth. The worst was 16. The best 10-year period was 51%, so it's not as good, but the worst was 24. So that's basically tells you if you want to lower your risk, you just wait longer. If you put your money in for 1 year and take it out, you could lose half. So you can see that this is not a great strategy. It's very high risk if you only hold for 1 year. All right, so now let's talk about when you might start taking your money out. And this is basically the higher your, what you're looking at is the ratio between the value of what you have and how much you're taking out. So you can see here that in 2020, this value above 3 million means the amount you're taking out is tiny. It's way less than the average annual variation. So it basically doesn't really affect your long-term outcome. 2021, we took out 300,000. The next year, the value dropped by half. But you can see the amount you took out didn't really matter because it was such a small movement compared to the overall stock growth and shrinkage. So if you just wait until your portfolio is huge, then you can take money out and feel safe and not worry that you're going to hurt yourself, hurt your fund. Now, there's a whole ton of other decisions that typical investors will consider and make, and you'll get advice on. In my opinion, for people who aren't like professional investors or just want a simple investment decision, you can basically ignore all of these. So, should you invest all at once or a little bit at a time? Well, either way will work. It is better to invest a little bit at a time, but for the strategy, if you're waiting 10 years, it doesn't really matter. When to buy, if you're waiting 10 years, the worst you'll do is 24%. So at least that's historically speaking. So any time is good. Which ones, you can just copy what I did, or you can make a rule that basically just look for high returns, average annual over a long period, and buy those stocks. So that's the important bit. I'll record a separate video that has even more detail, and I hope that was helpful.